Investing in stocks can seem intimidating, as no one wants to experience the regret of choosing a stock that ends up losing value. While losing money on stocks is a possibility, it's not just a game of chance. Wise stock picking involves analysis, strategy, and sound investing principles. By following the right method to evaluate stocks, you can avoid bad deals and seize valuable opportunities that others may overlook. So, how can you pick stocks wisely? Let's explore the process of evaluating and selecting stocks, which will set you on the right track. Even if you weren't born with a natural talent for picking valuable stocks like Warren Buffett, you can still learn to identify them. While professional stock picking involves various factors, here are 6 steps that can help you get started. 1. Start with companies you understand. History's most successful investors, such as Peter Lynch, Warren Buffett, and Ronald Read, have made fortunes by investing in companies they understand while avoiding those they don't. It's common sense, really. As a beginner, it's easier to evaluate companies whose products, business models, and industries you are already familiar with. For example, if you have a background in IT, you may have better insights into certain tech companies compared to retail companies. Conversely, someone with experience in the retail industry may be a better retail investor than a tech-savvy individual. However, it doesn't mean you should limit yourself to familiar companies. If you have a strong interest or curiosity in a particular industry, such as green energy, your passion can drive you to learn more about each company in that sector and help you make great stock picks. Avoid investing in companies just because others recommend them, especially if you have no understanding or interest in their operations. It's better to skip such investments unless you are willing to dedicate time to research and learn about that specific sector. So, as a starting point, invest in what you know and understand. Consider your hobbies, areas of expertise, and the products you already use. Somewhere within that mix, you'll likely find a great company for you to invest in. However, you'll still need to dig deeper to identify the best long-term investment. 2. Identify companies with strong competitive advantages. A competitive advantage refers to a company's ability to outperform its rivals by offering desirable traits that keep customers loyal to its products or services. Some people refer to competitive advantages as wide moats because they protect a company's market share from competitors. Although many people understand the concept of competitive advantages, they might not know the specific terms used to describe them. Typically, competitive advantages fall into one of 4 categories. Cost advantages. Companies with cost advantages provide good quality products at lower prices. These companies often have more efficient production processes or cheaper ways of distributing products. They might outsource labor to other countries or utilize artificial intelligence to reduce labor costs. Either way, their prices are more competitive than their rivals. Network effects. This occurs when a company's product or service becomes increasingly valuable as more users join. Examples include social media platforms like Facebook, where the more friends and family members you have on the platform, the less likely you are to switch to a different platform. Other examples include Slack and the learning module Docebo. Intangible assets. A company with a strong brand or a household name possesses intangible value. Their competitive advantage lies in the trust they have established with customers. In many cases, companies with intangible assets can charge higher prices for their products, even when cheaper alternatives are available. Think of brands like Coca-Cola or popular branded cereals. Patents are also considered intangible assets. High switching costs. Some companies have an advantage simply because consumers are reluctant to switch to alternatives due to the associated costs in terms of money, time, or energy. Banks and certain technological platforms like Shopify often benefit from this competitive advantage. 3. Analyze a company using key metrics. Identifying companies with competitive advantages will help you spot potentially excellent investments. However, to truly determine whether a company is a good choice, you need to dig deeper. This is where key metrics come into play. Metrics allow you to assess whether a company's stock is worth its price, undervalued, or a bad investment. While learning these metrics requires time and practice, they enable you to look beyond the surface and make informed decisions about a stock's long-term performance. Here are some key metrics you should consider. Price-to-earnings (PE) ratio. The PE ratio helps you understand how a stock's price compares to a company's annual earnings. It indicates whether the stock is over or undervalued. To calculate it, divide a company's market capitalization by its annual earnings. A low PE ratio suggests an undervalued stock, while a high PE ratio may indicate an overvalued stock, possibly a growth stock. Price-to-earnings growth (PEG) ratio. Similar to the PE ratio, the PEG ratio compares a stock's price to a company's earnings, but it also considers expected growth. To calculate it, divide a company's PE ratio by its expected growth earnings. A low PEG ratio suggests an undervalued company, while a higher PEG ratio may indicate an overvalued one. Price-to-sales (PSR) ratio. For growth-oriented companies that haven't reached profitability yet, measuring stock prices by their earnings may not be helpful. Instead, analyzing growth companies based on their revenue can be more suitable. The PSR ratio divides a company's market capitalization by its annual revenue. Price-to-book value (PB) ratio. The PB ratio allows you to compare a stock's price with a company's assets. Divide a stock's price by its book value per share to calculate it. Debt-to-EBITDA ratio. It's important to consider a company's debt along with its earnings. The debt-to-EBITDA ratio helps you analyze a company's debt. Locate the company's debt and EBITDA, earnings before interest, taxes, depreciation, and amortization, on its balance sheet, and divide the total debt by its EBITDA. A higher ratio indicates a company carrying more debt, which can be risky. These metrics, among others, will help you independently evaluate a stock's value, which is an essential skill for a stock investor. While some stocks may have prices close to their intrinsic values, others may be undervalued or overvalued. These metrics enable you to assess a stock's worth and decide whether to buy it or wait. 4. Examine the company's past returns. A company's historic returns provide an overview of its performance since its initial public offering. You may be familiar with the classic graph that shows a line fluctuating over the years, representing a stock's historic return. Analyzing historic returns helps you understand how well a company has performed during economic downturns and recessions. It also allows you to compare the company's performance against broader market indexes, such as the S&P/TSX Composite, to determine if the stock's return on investment, ROI, has outperformed or lagged behind the market. However, it's essential to note that past performance doesn't guarantee future results. Just because a company has been successful in the past doesn't guarantee future success. Historic returns provide insight into a company's journey and resilience during unfavorable market conditions. 5. Consider the stock's role in your overall portfolio. Once you have selected companies that you understand and have identified strong competitive advantages, valued their price using key metrics, and analyzed their historic returns, it's time for the final step, determining if the stock aligns with your portfolio. A well-balanced portfolio consists of stocks from various sectors, each with different value propositions and market capitalizations. If the stock you're evaluating fills a gap, increases your exposure, or provides a hedge against market volatility, it's likely a wise pick. On the other hand, if your portfolio is heavily concentrated in one sector, such as technology, and the stock you're considering falls within the same sector, you may want to diversify by exploring other industries. But doesn't this contradict the guideline of invest in what you understand? To some extent, yes. However, keep in mind that the most successful stock investors never stop learning. While you start with what you know, as you become more comfortable with investing, you can apply your knowledge to other sectors. This is how you build a portfolio of wisely selected stocks. By following these steps, you can approach stock evaluation with a strategic mindset, increasing your chances of making informed investment decisions and uncovering valuable opportunities that others might overlook. Remember, picking stocks wisely involves analysis, strategy, and sound investing principles, rather than relying on guesswork or following popular opinions.